Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Ramzan Karmali. Let's get to the 3 things you need to know today. First up, markets are looking to start the week in the green. US stock futures edging higher ahead of the opening bell as investors wait on key inflation data ahead of the Fed meeting next week. Both the consumer and producer price indexes are due, and it comes after a weak August jobs report, highlighting the continued slowdown of the labour market. And Wall Street almost certainly is certain that the Fed will start cutting rates next week. The CME Fed Watch tool showing an 88% chance of a quarter-point cut. Plus, all eyes are on Apple. The tech giant set to unveil its newest phone on Tuesday, the iPhone 17. It's expected to have a better camera, a larger screen, and the new Air model, which will be the thinnest iPhone ever. But the new phones will also likely come with a higher price tag. The Pro Max expected to cost upwards of $1,200. And the S&P 500 is getting a new look. 3 new stocks are set to be added to the index, including Robinhood, AppLovin and MCore, as part of the S&P's quarterly rebalancing. Robinhood and AppLovin missed the cut last quarter, which had weighed on the stocks. The changes go into effect later this month. But both Well, let's get a check-in on the stock futures. And as you can see, pointing to a positive start on Wall Street later. That's thanks mainly to the fact of that weak jobs report on Friday that's boosted global stocks as well. And that's definitely spilling over onto Wall Street this morning too. OK, well, let's dig into our top stories of the day. The August Consumer Price Index due out this week, offering a fresh read on inflation, plus stocks continuing to trade near record highs as investors stay bullish, and OPEC Plus agreeing to further raise oil production. Well, joining me now, senior reporter Ali Kanal, live at the Nasdaq, Fed correspondent Jennifer Schoenberger, and senior markets reporter Inez Ferre. Jennifer, let's start with you. What are we expected to see from the CPI report that's out on Thursday and also the PPI report out on Wednesday?
Hey, good morning, Ramzan. Yeah, consumer prices expected to heat up for the month of August. Headline inflation expected to tick up to 2.9% from 2.7%, with the core measure, which is the one that the Fed prefers, excludes volatile food and energy prices, that expected to hold steady at 3.1%. But if you'll recall, for the month of July, CPI tends to run a little bit hotter than PCE, the Personal Consumption Expenditure Price Index, another measure of inflation. So there is a risk that we could see this come in hotter than expected. The other thing I'm looking for is, if you'll recall, when we saw producer price index come out for July, that showed that the services side of inflation was starting to heat up. So prices that businesses are paying. I'm curious to see whether that is going to start to show up in consumer prices. So watching all of that in terms of both CPI and PPI this week.
And Jennifer, what does that all mean then for the Fed next week? I mean, the markets are pricing in pretty much a 25 basis point cut, but could we see more?
I think the markets have it right. The Fed is continuing to contend with both sides of its dual mandate. Just spoke about inflation. It's running a full percentage point above their 2% target. At the same time, we had that weaker jobs report on Friday, and it wasn't just the month of August that showed a weaker report. It's really been the last 3 months. This has been a trend. And so the Fed is going to need to assess how far they are from both sides of their dual mandate, from both goals, right? This is something the Fed Chair Powell has laid out. And so I think when they look at the full picture, they want to arrest any snowballing downwards in terms of the job market. And so I think that presents a 25 basis rate cut on the table. I think that we won't see 50 because we're seeing inflation run hot. If inflation was closer to target, then that may be more of a possibility on the table. The next question becomes, what does the path look forward for the rest of this fall?
That's interesting stuff. I mean, what does the path look forward? I've heard today from one analyst I spoke to earlier, maybe 2 other cuts for the rest of the year. How's that all playing out on the markets, Ali? Looking pretty positive to start this week.
Pretty positive. We have stocks trading at record highs, but it seems like the general sentiment on Wall Street is that we're trying to decide if we're bullish or bearish. We did have that disappointing jobs report. Those revisions really spooked investors. We will see those estimates on annual payrolls. Those revisions are set to maybe point to another loss of nearly 900,000 jobs. So that could set us up for yet another disappointment. And on Wall Street, there is a clear divide between those that are super bullish on the outlook and those that are maybe a bit more cautious. Ed Yardeni is saying that he doesn't think the Fed should be cutting at this point, that interest rates are fine where they're at, considering GDP growth is strong at this point. He thinks that there's a risk of a market melt up if the Fed starts to cut in this environment, and also the risk of cutting in an environment where inflation remains sticky. And as Jen was just laying out, we could continue to see hotter inflation down the line. But then you have others on Wall Street, like Goldman Sachs strategist David Kostin, who thinks that rate cuts will be bullish for this stock market and that it will extend the rally from just those mega cap tech names into some of those undervalued parts of the market, like small caps, which have really struggled under the weight of those big tech players since this bull market rally began just around 2 years ago. But even within the AI trade, we are seeing a bit of wobbly trading there. Nvidia, Microsoft, they haven't made new record highs in weeks. We're seeing a lot of money flow into maybe some more of the laggards, some non-AI plays like Apple, for example. So that just points to some of the uncertainty within this environment and how rate cuts doesn't automatically mean stocks are going to rally from here. So just a few things that I'm tracking this morning as we continue to see this Wall Street commentary, as we continue to wade through this economic data, and it all sets us up to what the Fed ultimately decides to do later this month.
And Ali, we've got quite an interesting take from Apollo Global Management on the S&P 500. They think it's too expensive. Why is that?
Yeah, too expensive because it's very top heavy right now. That is the argument. Apollo chief economist Torsten Slok saying that just a handful of mega cap stocks now make up more than 30% of the S&P 500. And for some perspective here, that's about 3 times the concentration that we saw during the dot-com bubble. We know bubble is a very scary word on Wall Street, but Torsten making the argument here that today's market is even more dependent on just a handful of those names. The Magnificent Seven driving nearly all of the index's earnings growth, while the rest of corporate America really just lags behind. Only modest growth there, with the small cap names really flat in terms of earnings growth. And you're looking at hyperscalers and the CapEx spend that's leading to the earnings gains. So names like Microsoft, Google, Meta, they're spending close to 20% of sales on the AI build out. The risk, though, is that if they pull back at all on that spending, we have not seen that yet in terms of what we've seen from earnings season so far. But if they do start to pull that back, the broader market could be very exposed. So that is the risk, the concentration risk that we've really been talking about throughout the course of this year. Apollo making the argument that that risk is very much present in this market, despite the fact that we have been hearing from strategists that there is a broadening out on a sector basis. But in terms of individual stocks, you still have those big mega cap Mag 7 names driving a lot of the gains.
And Inez, oil prices are higher today, and we've had some quite interesting news from the oil cartel OPEC+. Can you tell us a bit more about this?
Yeah, so OPEC Plus deciding to increase output by 137,000 barrels per day. And normally when you see OPEC Plus increasing output, you see a downward pressure on oil prices, but you're seeing an upward pressure right now on oil prices. And part of that is because the street was expecting more of a raise. So perhaps this is more of a modest raise than what the street had been expecting, and more modest also than what OPEC has been doing over the past a few months, because remember that OPEC has been increasing output since April by 411,000 barrels per day in July, by 555,000 in September. So this is really a modest increase. So perhaps the market had gotten a little bit ahead of itself. Last week, you saw a decline for the week of 3%. On Friday, you saw oil prices selling off. Goldman Sachs came out with a note basically saying that this leaves their price targets unchanged for 2025 and 2026. They are seeing that Brent is going to average $64 per barrel in 2025. That's lower than what we're seeing right now. And also in 2026, they're expecting Brent to average $56 per barrel. So that's because of oversupply in the market.
But that could even change a little bit more, though, because we're having more news of potentially more sanctions against Russian oil. So maybe that could weigh the other way, no?
Yeah, and look, there's been a lot of talk about more sanctions on Russian oil and what the U.S. is going to do. The EU wants the U.S. to put more sanctions on Russia because it's saying that it wants to end the war in Ukraine. But what's interesting is that the Energy Secretary, Chris Wright, has basically said, look, if the EU wants more sanctions, then they should really not buy energy from Russia and be buying more energy from the U.S. because the U.S. has been pushing for a lot more LNG, liquefied natural gas exports. And the EU is planning to buy more LNG from the US. But nonetheless, it has been making this push for more. And the EU is drafting up some rules to phase out their energy dependence on Russia by 2028. There are some states that are opposed to some of these rules. So we'll have to see how all of that shakes out. But certainly more sanctions on Russia would certainly impact, at least in the short term, it may have some impact on oil prices.
Inez, thanks for that. Ali, Jennifer as well, thank you for all your input. OK, coming up, we count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We're watching EchoStar, Summit Therapeutics and new additions to the S&P 500. Well, let's start with the S&P 500 soon-to-be members. Robinhood, AppLovin and MCore all jumping today on the announcement they will join the benchmark US index. The three companies will replace MarketAxess, Caesars and Enphase Energy prior to the start of trading on September 22nd. By joining the index, those stocks will enter the portfolios of index funds, pension plans and retirement accounts across the world. Now, next up, EchoStar striking a $17 billion deal with Elon Musk's SpaceX. The space exploration company agreed to acquire wireless spectrum from EchoStar for about $17 billion in cash and stock. EchoStar will use proceeds from the deal to retire some of its debt, as well as fund its continued operations and growth initiatives. And finally, Summit Therapeutics shares plunging after the release of new data cast doubt on the future of a closely watched lung cancer drug. Analysts flagged discrepancies between Chinese and Western data in a key study after Summit and its partner Akeso released results showing the drug showed an improving favourable trend in helping patients from North America and Europe live longer. The drug has drawn scrutiny as a potential rival to the world's top-selling cancer therapy and became a symbol of China's biotech ambitions after Summit licensed it from Akeso in a deal that could be worth $5 billion. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Now, September is historically the worst month for stocks, but this year could buck the trend as rate cut expectations boost the market. Well, joining me now is Michael Reinking, NYSE Senior Market Strategist. Michael, thanks so much for joining us. Well, let's start with that thought about September. It's usually a pretty, historically, not a great month. Could it buck the trend then?
Yeah, so it's pretty interesting. As you pointed out, right, we're in this 2-month period, which tends to be one of the worst 2-month periods for equity markets, kind of throughout the calendar year. That month of September is the only month where we have seen, kind of a negative return profile historically. At this point, I think markets are, kind of very much focused on, kind of where, the Fed is going to move. Last Friday's employment report, definitely, confirmed that we're going to get that 25 basis point cut, in a couple of weeks. As we look out, this week's inflation data is going to be pretty important, and the BLS, and the BLS revisions tomorrow. if you see a bigger than expected revision number and some weaker than less inflation on that CPI report, we could start to hear the conversation around a 50 basis point catch-up rate cut in a couple weeks.
And
Michael, as you can see, it's getting pretty busy down here.
It definitely does feel that way, yes. Michael, as you mentioned there, let's stick on that inflation point. This is the last sort of clues for the Fed before they make their rate call. So it's really vital that the markets pay attention to what we get, right?
Yeah, and so I think this week's data, unless we get a very, very big surprise to the downside of inflation, it's going to do more to shape kind of rate cut expectations, kind of as we move forward through the remainder of this year, right? So coming into last week, we were looking at kind of 2, potentially 3 rate cuts. Markets have started to shift to 75 basis points to potentially 100 basis points of cuts by the end of this year, and that's just starting to work its way into markets.
And as those rate cut expectations seem to have got a boost, the price of gold is also still on the rise. Can it show? It doesn't seem to show any sign of easing. Am I right in thinking gold is the way to go?
Look, I mean, gold has been in a very bullish trend for some period of time, right? As we've seen the U.S. dollar weakening. Excuse me, sir. If you could just slide out of the way. As we've seen the U.S. dollar weakening over the over the last kind of 6 months or so, we've really seen kind of gold moving higher. We have kind of the sanctions that the administration has put on kind of Russia and other central banks, is making central banks start to rethink kind of where they kind of start to allocate kind of capital, and you're starting to see kind of a move away from the U.S. dollar.
It's really busy there at the NYSE, as we can see.
Yes.
Moving on to some corporate news. The big event tomorrow is Apple's launch for their new iPhones and other devices as well. What are you hoping to see from Apple?
Look, I mean, markets tend to react pretty positively, kind of to those new launch cycles. I think, from the market perspective, they're kind of really looking to see kind of what the company is doing in terms of AI, and that's been kind of the real kind of focal point. Kind of in terms of AI, right? I mean, the one of the big talking points coming out of this weekend is the kind of the bigger cash burns that we're seeing at OpenAI, right? And we're really seeing just how capital intensive that AI projects are. We do have Oracle earnings, which is probably the biggest catalyst, for that complex this week.
You mentioned Oracle as well. We get as I put it, the OG of meme stocks, GameStop as well, reporting too. But the earnings season is coming towards an end. What have you made of the earnings season this time around, Michael?
Yeah, look, corporate America continues to perform really well. Right, they've done a lot to mitigate some of the costs associated, kind of with tariffs, and we've seen, kind of margins holding up, pretty well at this point. From kind of taking that back to, kind of a bigger macro perspective, I think the real key, as we're really focused on, kind of on the labor market, is that if we don't see companies begin to cut headcount, right, then we can continue to kind of move through, the current time period of, kind of a little bit of economic weakness. If we start to see companies cutting headcount, to offset some of the demand weakness, right, that's when things can get a little bit more dynamic.
Michael Reinking from the NYSE, many thanks for your thoughts.
All right, thanks for having me.
Well, that does it for Morning Brief. Much more ahead on Yahoo Finance. Opening bid is up next.